This trading strategy I'm about to show you is called a gap over red. Now I'm going to demonstrate it by going over the recent price action of the E-mini, where this gap over red setup allowed me to catch this explosive move to the upside. And by the way, it doesn't matter what asset you trade, whether you're in stocks, futures, forex, options, or crypto, this trading strategy is something you may want to add to your playbook. So what is the gap over red strategy all about? Well, it is quite simple. It's when the previous day closed as a red candlestick and price gaps above it during the extended trading hour session the next day. When this happens, institutions that shorted the previous day will be trapped in, and when traders are trapped, those are the conditions where there's a chance for an explosive move. In the case of the gap over red, you are looking for an area where shorts have initiated, because the next day when price gets above that area, bearish institutions will either have to get aggressive to aggregate price back down, or they'll have to get out break even with limit orders if it gets back to that area, causing support to form. Since these bears have converted to limit order bulls, it's important to note that when limit order bulls are successful, this results in intraday stop order bulls to enter, causing higher prices. Then the remainder weak bears have no choice but to buy the market along with the bull breakout traders after the limit order and stop order bulls cause a successful bull flag, which starts the attempt of an uptrend. So this is a rudimentary overview of the whole thesis behind this strategy, but it's not all there is to it. To increase the probability, there are certain conditions that need to be met in the market cycle, as well as the need to identify the level of reference, which is the area that bulls and bears are fighting over, aka where shorts have initiated. In other systems, this is also called areas of supply and demand. So let's begin with the market cycle criteria. The two most common times where the strategy has the highest probability is on names that are on a daily time frame uptrend or gapping above a red bar at the bottom of a trading range. In the case of this real life example here, we see that it meets the criteria of an uptrend because we are putting in higher lows and higher highs. We see a wave up, wave down, wave up, wave down, and wave up. And right over here, we put in two small bear bars, which in the context of this wave up can act as a bull flag. And if you notice that we are gapping above the open of this prior bar. The next criteria is identifying the level of reference and making sure that we're also gapping above that during the extended trading hour session. This is quite simple. The level of reference is drawn by plotting the trend changing bar's opening print on the regular trading hours on the hourly time frame chart. For example, we have a leg down which originated from this green to red flip here, so plot the level at the red bar's opening print. This is an area of supply and demand that both bulls and bears are trying to control. So when the market opens, it slightly favors the upside given that 1, we're in an uptrend, and 2, we're gapping above a level where shorts initiated. These areas act as magnets, so most of the time it gets tested before price decides what it wants to do next. And the cool thing is, you only take an entry when favorable price action forms. The easiest way to describe it is if a limit order bulls show up, then you can take an entry with a stop order above the signal bar that is created by the limit order bulls, preferably at the close of a 5-minute bull bar. If limit order bulls do not show up around this area, that means you don't take an entry. We rely on the pullback to demand to get in at a flag to achieve a reasonable risk to reward ratio. So in the case of this real life example, we see in the pre-market we're strongly gapping above this level, and as market opens we get a pullback to this area. In hindsight, this would be a good entry because of the context of price action. Even though you're buying above a bear bar, it's overshooting a wedge bottom trend channel line, which I'm not going to draw, but you can see that we get 3 pushes down to meet the criteria of a wedge. 1, 2, and 3. Real time, I personally did not take this trade just because there was 3 consecutive bear bars, and buying above a bad signal bar usually results in the price testing back to that area in the future. After making this leg up about an hour and a half into the day, we see that price comes back down to the level of reference, this time meeting the bare minimum criteria of a buy signal bar. Even though it's not a bull bar, its closing price is at the open. More importantly, the context is that we're forming a potential double bottom bull flag, and limit order bulls are clearly strong in defending this area. So that means it makes me as comfortable as a stop order bull to take an entry above the signal bar. As this right here is only a potential higher low on the intraday uptrend, the correct stop loss placement would be back here at this confirmed higher low. Remember, your stop loss placements should be in areas where you would be wrong on the trade. So if you're betting on an uptrend, you would only be wrong if price gets below a major higher low. As for the profit target, there is one issue here, which is that we're at all-time highs, so we cannot use past price action to gauge where a resistance might be. In this case, you have to rely entirely on some sort of measured move. In my case, I use this leg 1 equals leg 2 measured move from this larger bull flag that was currently playing out. My profit target is just slightly below this measured move, and if we drag up the profit target, you can see that this will become almost a 3-hour trade. You don't want to enter on anything below a 2-hour trade because that's the minimum risk to reward for a positive trader's equation, given that this strategy structures around the 40 to 50% win rate. As for trade management, you can raise your stop loss every time there's a confirmed higher low. I manage all my trades on the 5-minute time frame, as that is what I found to be the most reliable when day trading, to avoid getting stopped out too early and also avoid giving back a good chunk of profits. So here, as we get our first pullback, we see it turns into a bull flag, and after breaking out to a new high, along with a follow through bar over here, we can raise stop loss into profit below this confirmed higher low. We then hit the profit target. It's up to you how you manage your trade, but I like to take majority of my position off at the planned profit target and leave a runner until the trend is broken. Here we get another pullback, breakout, follow through. You can raise your stop. Pullback, breakout, follow through, raise stop. And you keep on doing this until there is a reason to exit. Pullback, breakout, follow through, raise stop. Pullback, breakout, follow through, raise stop. Now here we are late in session, and we're getting the best looking bull bar late in a bull trend, which can be a possible exhaustion. Also, given that we're near the end of session, this should be viewed as a gift, so take profit at the close of the bull bar. You can see in hindsight we got another big bull bar, so if you haven't already taken profits, you should definitely do so here. So this was a price action breakdown of not only the gap overhead strategy, but also the basics of trade management. Hopefully you learned something new. If you like these videos, make sure you give it a like and let me know in the comments what type of videos you want to see.